Live from Hong Kong, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Copper futures surge on a Bloomberg report that President Trump could put import tariffs on the metal within weeks. Trump also stressing in a TV interview that he wants to limit exceptions when he rolls out reciprocal tariffs next week. While investors make sense of that, their concerns about the U.S. economy grows, with consumer confidence falling in March to the lowest in 4 years. The main fear points were high prices and tariffs. And a great lineup of guests today on Insight to gauge the global impact of Trump's tariff barrage. From the HSBC conference here in Hong Kong, former UK Chancellor of the Exchequer George Osborne, and also Apollo Global Management President Jim Zelter will be live in just a few minutes. And later in the show, M&G Asset Management CEO Joseph Pinto joins us to discuss his big bets on private markets. And we speak exclusively with the Sri Lankan Central Bank Governor, fresh off his decision to hold rates for a second straight meeting. Our top story today, President Trump says he plans to limit exceptions to his tariff push in the latest cryptic hint about a planned April 2nd announcement of reciprocal tariffs on global trading partners. Meanwhile, sources also tell Bloomberg that U.S. tariffs on copper imports could be imposed earlier than expected. For more, let's bring in Bloomberg Asia senior editor Bill Ferris. And Bill, Trump says he doesn't want too many exceptions in a tariff push. What exactly do you think he means by that?
Well, we seem to have a kind of more information coming every day on what might happen April 2nd. That's the Liberation Day, as Trump calls his planned day for introducing reciprocal tariffs. When this discussion started, we thought there might be a wall of tariffs on all countries around the world based on what they charge the U.S. That has since been scaled back. Trump has suggested that maybe not every country will face the full brunt of reciprocal tariffs. But now he's also saying he doesn't want to have a lot of exceptions to those rules. We know it was going to be difficult for the U.S. to implement a full suite of tariffs on every country around the world because, frankly, countries charge different rates for different products. It was going to be a lot for the Commerce Department and other agencies to carry out. But Trump is signaling that he doesn't want a lot of negotiating going on before April 2nd in terms of countries lobbying to be exempt from these processes. So we may get more information tomorrow. It's hard to tell, but every day there seems to be a little bit of moving of the goalposts, as they say.
That's right, and it's drip, drip. We know that Venezuela, in particular, is getting targeted. Any imports of oil and gas from Venezuela may be looking at secondary tariffs?
Yeah, that's right. He's talked about, and it's interesting because the U.S. is one of the big importers of Venezuelan oil. It goes to, that heavy crude goes to a lot of refineries in the American South. But the other big buyer, obviously, is China. So that may affect their ability to get the Venezuelan crude. Cuba is another buyer. But the Trump administration definitely signaling a harder line on Venezuela that had been eased under the Biden administration, who didn't want to see gas prices going up. That seems to be less of a concern for the Trump team at this point.
That's right. And also copper imports. We're seeing copper prices surging on the back of that. Bill, U.S. says Black Sea truce agreed upon, even as Russia is laying out the terms.
That's right. Ukraine coming out and saying that they are going to abide by this ceasefire reached over shipping in the Black Sea. Russia saying it, too, will agree to a ceasefire if its banks are exempt from sanctions related to the trade of agriculture. That wasn't something that seems to have been a part of the agreement in Saudi Arabia. Donald Trump saying he is looking at those conditions and even suggesting that he thinks that President Vladimir Putin may be dragging his feet on a broader ceasefire deal. So we'll have to wait and see how effectively this is implemented, whether it gets put into place at all. But Ukraine, at least for now, signaling that it's willing to abide by this Black Sea ceasefire and that it's willing to accept a much broader ceasefire as well. So I think that puts the ball really back in Russia's court.
Bill, thank you so much for that. Bloomberg Asia senior editor Bill Ferris there. Let's do a check-in on how markets are faring as traders continue to digest trade and geopolitical tensions. Evil Hong has the very latest, and it seems like some gains today.
Yeah, we're seeing gains in commodities, but when you talk about digestion, I think it's more a likelihood of indigestion given the geopolitical and tariff noise. And I'm about to add to that because, as you heard from Bill, when it comes to this Black Sea truce, what that's really prompting is the idea that Russian crude could flow freely. But if you look at oil prices and how they're gaining ground today, you wouldn't think that was the case. It was, I think, also a bit of that cross current coming in from U.S. stockpiles, right? That data showing a drop. So that's really hard to digest the drivers for commodities today. If you flip the board and take a look at how copper prices are moving, and of course, this has been quite a steady climb since earlier in the year where Trump has been signaling that we could see tariffs on the commodity. It, rose even further today after sources told Bloomberg, that scoop, right, that we could see these levies within weeks. So that extension of the gains, copper producers are also tracking the gains in the commodity today. Now flip the board and take a look at the disconnect in the markets, because as we see how these U.S. contracts have been rising as traders kind of price in these incoming tariffs potentially, there's been a widening spread with contracts in London, for example. So one of the side effects is how traders have been scurrying to kind of ship the commodity to the U.S. Another side effect we've been seeing also is how it's left other markets kind of with this shortage of the commodity because of everything that's going to the U.S. Haas.
That's right. Avril Hong, thank you so much for that. We're also keeping an eye on the British pound. The UK's Chancellor of the Exchequer, Rachel Reeves, is expected to announce further government spending cuts in a spring statement later Wednesday. Higher borrowing costs and weak GDP figures are piling on the pressure for her to meet her own fiscal rules. She's facing increasing opposition from her Labour Party colleagues over a politically unpopular overhaul of welfare spending. Now let's cross over to the HSBC Global Investment Summit, where David Inglis and Rebecca Chung-Wilkins are standing by with a very special guest from the UK. Take it away.
Yes, we're joined really by the perfect person to talk about this. We have former UK Chancellor of the Exchequer, George Osborne, with us. We'll start there. My colleague was just talking about the budget that we're expecting today. If you were standing at the podium, you're still Chancellor, what would we see you delivering?
Well, I think the overall message needs to be a bit of a reset, frankly. The government didn't get off to the best of starts, so they had a lot of goodwill and inherited problems. But the result is at summits like this, on the other side of the world, there's quite a negative sentiment about the UK, and that needs to be changed, and the government can do some things to show they've got an economic plan, the plan is pro-business, the country's going to live within its means, and if Rachel Reeves can deliver that later today, all for the better, and certainly I wish her the very best of luck.
Any advice?
Well, I think, plan beats no plan is the old adage, and I don't think at the moment people here sense that the UK has a clear direction that it's heading in.
Yeah.
And I think, Rachel Reeves would say, well, I had a black hole to fill and I've had to fix various problems. Maybe, maybe not, but what's true is the government has not until quite recently given an unabashedly pro-business or pro-enterprise message. If anything, it's been kind of raising taxes on business and pushing entrepreneurial and wealthy people away. That can change, and certainly I think the messaging in recent weeks has been a lot better from the government and a lot better from Keir Starmer, the Prime Minister. Yep. But this budget, if it walks like a budget and quacks like a budget, it is a budget, even if Rachel Reeves won't call it that later today. This is a moment to sort of cement some of the good work of recent weeks.
What do you think the government is still getting wrong?
I think the overall message about the UK, and this has been true for a number of years, has not been one of overwhelming positivity towards the private sector, business and enterprise. And it started under the previous Conservative government. I was a Conservative Chancellor almost a decade ago, so, but I will say the last few Conservative governments had an ambivalent message about business. Then you got a Labour government that came in actually saying a lot of good things about business, but its immediate actions were to jack up tax on business, jack up the wealth taxes and the kind of things that allowed, for example, non-doms to remain in the UK. And the result has been quite a negative sentiment about the UK, against a backdrop in which anyway there was a question of how countries like Britain, applies to other European countries, are going to make their way in the world. Now, I think that can change. These are not unfixable problems. And there's a lot of strengths in the UK economy that can be talked up and supported by policy.
I mean, to your point about, the pro-business or not atmosphere, the question of investability, of course, we're here at the HSBC Global Investment Summit. What is the question that you're most often getting here? And I guess how much interest is there in the UK?
Well, look, the word, of course, on everyone's mouths, like everywhere else in every other policy forum, is Trump and tariffs, the two words. And, no one knows what's going to happen next week. And the UK, like other European economies and other allies of the United States, like Canada, are very affected by those decisions. So there's certainly a backdrop of policy uncertainty. It's self-induced uncertainty by the US government. Now, I think the question is, I'm not, by the way, someone who's ever supported tariffs as a means of, advancing a policy objective. But if the administration is serious about tariffs, then I would advise them to kind of get on with it, settle the issue, and allow the instability to settle down, and allow the tariffs to be priced into business and trade. It's the double whammy of the tariffs themselves, which are clearly a cost on trade and a cost on consumers and a cost on business, plus the uncertainty of whether they're happening, who they're applying to, and so on. And I think it's the combination of those two things. Now, if you're a tariff guy, as Donald Trump says he is, and to be fair, told the American people before the election he was, then he needs to remove the uncertainty, and I think that would help a lot. Obviously, in my view, the ideal thing would be to try and return to a more free trading world.
The other byproduct that certainly wasn't on my bingo card, at least this year, because of Donald Trump, is this pickup in defense spending that we've seen in Europe. How do I need to be thinking about that? Does that matter to corporates here in the Asia Pacific? Is it sustainable, this increased fiscal push, if you will?
Yeah. Well, you can't have a strong and healthy economy without security, and you can't have strong security without a healthy economy. So they're somewhat symbiotic, and they support each other. Of course, what the US administration has done is thrown into some doubt the US security umbrella over its allies, and that's led to some pretty historic decisions by Western democracies to take more of the burden of their own defense. Now, to be fair to Donald Trump, a lot of American presidents have been asking for that in the past, and he has achieved it. The question is at what cost? But I think if you look domestically, the announcement of the German government is really significant. When I was Chancellor, everyone was trying to get Germany to spend more money. And now they are, and I know Friedrich Merz pretty well. It's an unusual announcement coming from a conservative German politician. And of course, rearmament is something that hasn't been in the post-war German lexicon. So, pretty big moment, not to be underestimated. I mean, I would say rearmament is not the most straightforward way of stimulating an economy. I mean, you wouldn't rearm as your most efficient fiscal stimulus. There are other ways to use fiscal policy if you want to support the economy. But if you are going to be rearming for reasons of security, then I would say make sure the money, and this applies to the money, by the way, that Britain's about to announce today for its defence budget, make sure it goes into innovative new technology on the battlefields that's come out of the Ukraine experience. If say, the British defence budget just goes on money spent on cost overruns on some 10-year-old frigate programme, that's not going to help anyone. It's not going to make us safer, and it ain't going to help the economy. If it goes into some of these really exciting new defence startups, that you've seen in the US and you're beginning to see in the UK and continental Europe, then there may be a kind of collective win for the West.
I mean, that's an interesting point, this question of implementation. Were you in the Draghi, you were listening to Draghi speaking earlier. I mean, do you think that Europe is receptive to that message?
Well, I think the Draghi report and Mario Draghi himself has had quite a big impact in kind of making Europeans face the music of their economic situation. The question, of course, as you say, is can it be implemented inside the structures of the European Union? And to some degree, you need this crisis to force action. That's often the case in democracies and complicated international organizations like the EU. So if you're looking for a kind of silver lining to the kind of policy uncertainty, the uncertainty the Trump administration has brought in Europe, this may be it. And there's certainly, I think, a discussion in every European capital now. How do we get our economy growing? How do we protect our country? And those are conversations prompted by Trump.
George, it was nice to see you, and thank you for spending time with us. George Osborne, the former UK Chancellor, of course, of the Exchequer, joining us here at the HSBC Global Investment Summit. Right, at this point in time, I think let's send it back to the studio. Has, I think you have some news coming through out of Thailand now.
That's right. We have breaking news out of Thailand. Thai Prime Minister Paetongtarn surviving a no-confidence vote. The Thai Parliament voted 319 to 161 to back the Prime Minister in that confidence vote. Now, this country, of course, has been under a lot of pressure in terms of not just the political scene, but also the economy. It is under pressure from a weak currency as well. The central bank under pressure to cut rates to revive that economy. Again, the Thai Prime Minister Paetongtarn has survived that no-confidence vote. Now, still ahead this hour, Apollo Global Management President Jim Zelter will be joining us live and exclusively from HSBC's Global Investment Summit here in Hong Kong, with attention focused on the risks to growth. Keep it here with us. This is Bloomberg.
You're watching Insight. Dave and I still here at the HSBC Global Investment Summit. And it's been a really busy conference. Tariffs front of mind, of course, but also this big question over uncertainty. Yeah,
well, let's talk about everyone's favorite restaurant these days. Apollo Global Management joins us right now. Okay. Jim Zelter, of course, the president. Rebecca was wondering where I was coming from there. Jim, it's fantastic to see you.
Thank you. Glad to be here, and it's such a wonderful event.
We were just talking during the break. Not a week goes, not even a day goes by that I don't see Apollo in the news. You guys are making a lot of moves.
Well,
what's busy or what's not busy?
So listen, I appreciate it. At the end of the day, it's all about providing investor solutions. We have been at the cutting edge of a lot of areas. Certainly, our DNA in private equity is a key part of the firm. But the last several years, the last decade, private credit has really been the big driver of our business. That's about 600 of our 800 billion today. And for us, we've been active in the region for a few decades. But the four big themes for us: funding the global industrial renaissance, the whole public-private convergence, global wealth, and really the pension deficit problem around the globe. We want to be at the cutting edge of those four conversations.
And for Asia specifically, where are you seeing the opportunities?
Well, for Asia specifically, broadly speaking, we're quite active in Japan in the private equity business, but also in the insurance business and really bringing U.S. Investment solutions to those Japanese insurance companies. We're doing the same in Hong Kong and Korea, very active in global wealth, bringing some of our great U.S. products and U.S. and European products in direct lending and asset-backed investing and private credit to investors. In Australia, we've been very active with the super funds for a few decades and are working with a variety of the banks as they are optimizing their balance sheets and how we partner with them. So it's varied in the various regions of the Asia-Pac region.
And I know you probably get this question a lot, but I wonder if it continues. The structural conditions and forces that have led a lot of markets to come out of public markets and really into places like where you guys do the really good work.
Yeah.
What do you think those structural factors are? And do you think that there is, for the foreseeable future, those will remain in place?
Sure. Well, I think there's two big drivers of our structural benefit. And as Mark and I both say, we're in a business that gets better every day because people are getting older around the globe. So as people get a bit older and they get a bit wealthier, how they want to think about their investment portfolio, where in the past it really been public markets, which were a great diversifier and great grower. You know, the institutions for the last 20 years have really done a lot with private markets, private equity, private credit infrastructure. So bringing that whole solution on the investor side is what's driving our business. The second is the secular evolution of banking. Today in the US, about a third of credit is provided by banks, 2/3 by non-banks. In Europe, it's about 50-50. In Asia, it's still massively dominated by the incumbent banking market. That being said, more and more financial institutions want to find ways to partner with us on optimizing what they do. And we have a very attractive longer-term liabilities. And so bringing those liabilities, so it really is on the issuer side as part of the financing ecosystem, and on the investing side with really the providing solutions to pension funds and other older investors. And Australia is a great example. They have an amazing superannuation industry.
Yes.
You know, started in 1992 as a great idea for dignified retirement and pension. Today, that's 16 million Australians and $4 trillion of investment, but it only really goes up until you retire. So how do you deal with the post-retirement guaranteed lifetime income, and how do you deal with that lump sum distribution? So we want to be part of that conversation in the various regions.
I mean, pick up on your point now about expanding your footprint here in the Asia Pacific, wanting to have more partnerships. How do you think about those relationships? You know, the banks and private credit. How do you characterize your relationship, your tie-in with HSBC, for example?
Sure. Well, for HSBC, they're going through a strategic evolutionary change in their business, how they define their business, how they refine how they want to use their balance sheet. And we're finding ourselves with conversations with their leadership team, with their CEO, with their head of US, on being a great partner to them as they find they have the client relationship, but they want to optimize their balance sheet. And so for us, a very active dialogue with HSBC. But I'd also say it's in Japan with the incumbent insurance companies. It's in Korea with the big sovereign wealth funds. It's in Australia with the super funds. So in each region, you're partnering with the incumbents in a very strategic manner.
I'd like to get your thoughts as well on, you know, since, let's call it the latest iteration of private credit, when it became suddenly very, very popular again.
Yes.
I mean, I know you guys have always been in the game, and you know, so when I was starting to brew, I was thinking to myself, at some point people are going to start asking about more liquidity. And you know, there have been recent calls about whether that's securitization of some part of the private credit market to improve liquidity. Where does your head stand on that? And does that take away from the alpha that actually it brings? Is that almost a counterintuitive?
Yeah. No, it's a wonderful question. I guess I would say is you got to start with what private credit is today. And in our definition, it's much broader than the traditional definition of direct lending to sponsors. We look at private credit as virtually every activity on a bank balance sheet, which 80% of that is investment grade activities, fund finance, inventory finance, trade finance, and so on. And so for us, we want to be a broader provider of that capital in terms of private credit. And then as you do more and more investment grade activity, as more and more investors come on in, they want to see transparency on pricing. They want to understand what's going on in terms of valuations. And so for us, the natural evolution is to expand the broader definition of private credit in financing solutions for investment grade companies. And then those investors, whether they're institutions or private wealth, they want to see a greater degree of transparency and valuation. So we're doing that. We've done some interesting things in the US with partners. We've been part of an ecosystem that created an ETF for private credit.
Yep.
The underlying assets of those are investment grade. But from our perspective, it's this evolution of the marketplace. In the early 90s, no one traded loans. Loans were not public. Loans were very illiquid. And now, 30 years later, loans are a very liquid asset class, and sometimes even more than investment grade debt. So we want to be part of that conversation in partnership with investors as well as issuers when it's appropriate.
And there's one topic we haven't discussed, which has been very unusual in light of where we are and what's happening, which is, of course, Trump and tariffs. They're the two big words that have come up.
Yeah.
Do you think, I mean, we're sitting in a region that is probably, if not the most, one of the most vulnerable in the world to reciprocal tariffs and secondary effects. Do you think markets have sufficiently priced in the risks?
Well, I think you have to be a little bit more longer term. I do think right now I would preach patience and perspective. I think at the end of the day, what this administration wants is greater global competitiveness by American companies. And when that creates market volatility, that's when private market solutions, debt and equity, are a very active tool for companies to use. So it's going to be a long journey. I know it's very easy to get distracted with the headlines right now, but in the end of the day, there's been four big trends in the last 35 years or so. Lower rates, deregulation, technology, and the last, globalization. Certainly globalization is being redefined right now. Trade, supply chains are being redefined. And so for us, making sure we're a partner with companies in various countries around the globe as they redefine their strategy, along with investors trying to redefine their strategy in a period of market volatility, that's what I see over the next couple of years.
I guess over the short term, just to build on what Rebecca was just asking there, has the uncertainty had any short-term impact on the outlook for deal origination, for example?
Certainly the soft data back early in the last month, whether it's the airlines, Delta and American, whether it's some other consumer-driven companies, the soft data would tell you that the U.S. consumer is being a bit more cautious. They don't have quite as much confidence. The hard data is not in yet. The hard data will be in a few months. But I would say it's interesting to see how, raising rates almost 400 basis points the last couple of years didn't create a slowdown of financial conditions. But this administration, quickly because of headlines, has created a bit of concern. So it's a long journey. We're an investor that has, through many cycles, provided ways to create alpha to investors. We expect to do so, but we also want to be a solution provider from companies that are locked out of the market right now. And when you have this kind of volatility in the headlines, that's an opportunity for private markets to be a broader solution.
Right, and you mentioned this, the path of rates the last few decades has been down, and recently this 400 basis point move out of the Fed.
Yes.
We're trying to figure out where the floor is in the next cycle. Is it a lower floor on rates? Like, what's your assumption?
You've got a couple big prevailing factors around the globe right now. Certainly less globalization would mean higher rates, because the inflation, the deflation that's been exported out of Asia to the rest of the world would probably slow down. The countervailing impact, so that would tell us that rates should be a bit higher. The countervailing impact of that is technology and AI. Of the four big tailwinds that I mentioned, globalization, regulation, and lower rates, they're all going to probably change, but the impact for technology, i.e. AI, may be very deflationary. So how the countervailing impact of globalization versus technology impact, whatever side wins there, will be either higher rates from less globalization and a lower impact from AI, but a massive impact of technology and AI will probably bring deflation back, and we'll have lower rates. But that's over 3, 5, 7 years. But in the next 24 months, we suspect rates will be a bit higher than the base rates have been over the last decade or two.
Earlier this year, you talked about the US still being this beacon of economic opportunity. I'm just wondering if your conversations with investors, potential partners, and so on has shifted about the US in recent months, and what the kind of questions you're getting about the US these days.
Well, the global industrial renaissance is certainly U.S. because of data centers and technology and and energy and utility lines and such. But certainly in the last month, we all talk about Make America Great Again, but this administration has probably opened up the idea of Make Europe Great Again, and the massive changes that are going on in Germany. So, we still believe that the U.S. is a very robust economy. It's no surprise that the place that really has embraced private markets is the leading grower around the globe. But I think other markets are embracing private market solutions as well on the equity, the credit, investment grade side as well. So we're excited about the future. It may be a turbulent short term, but again, when we get back to the big themes of Apollo in terms of funding that renaissance, in terms of dealing with the pension deficit around the globe, in terms of bringing these products to more global wealth investors, we're excited about the future of our company.
Final question, how are you looking at your resource footprint here in the region? It seems like you guys are busy. It seems maybe too busy for
well,
footprint.
I've been with my team for the last 6 days, and every time I get a break, they say we need more people. So we've been responding. Every year, the growth engine of Asia continues to increase for the impact to our business. We're being thoughtful about it, but we're excited, and our leadership team makes sure we have our feet on the ground here a couple times a year, if not more.
Yeah, and of course, Matt does a fantastic job.
Matt's done an amazing job leading our business out here, and we're very happy to have such a strong leader in the Asia-Pac region.
Jim, thank you so much for taking the time,
glad to be here.
The better part of 25 minutes with us. Thank you so much.
Thank you both.
That was Jim Zelter, the president, of course, of Apollo Global Management. I'll send it back to you in studios.
About private credit. There's so much love when it comes to those assets. Let's bring in our next guest. Joseph Pinto is CEO in M&G Asset Management, which looks after almost $395 billion of client assets. He joins us exclusively here in Hong Kong. Thanks for joining us. We've been talking about private credit. We talk about democratization of private credit, retailization of private credit. Where are we going with this space?
So let me start effectively first with your previous guess. Indeed, the private market is booming, is growing. Private credit in particular. Our self-managed more than $25 billion in private credit, mostly from our European-based activities. We've just expanded by buying a new company called P Capital Partners based in Sweden, as we want to expand internationally our activities. And indeed, we see client demand coming from institutional clients, but more and more from retail customer or wealth clients, usually approached through distributors, banking, private banks or other distributors. So yes, it is growing, back to your question. So we see more and more demand, whereas indeed, we still need to be careful how we promote those strategies. It needs to be accompanied with the right training, the right support, so that clients understand what they get into.
Some suggesting it is actually an overcrowded space. Others, like BIS, suggesting that perhaps, that could be a mismatch, the way we have seen among banks. Do you see any distress or any signs of?
No, I would not say there is an overcrowded space. Yes, it's a competitive space, but we do believe there will be more and more demand in the future. Why? Because clients want also, private clients have the right to benefit from what we call the illiquidity premium, having better returns for their assets. They deserve so. So it's up to each player to provide the right offer to the clients. We need to pick up places where we can have a unique value proposition. That's what we've been doing at M&G, and we're very proud of it. And we need to make sure, again, that we do it the right way and that we avoid any mis-selling and we accompany our distributors to position the products for the right clients. That's what matters.
It is about getting the opportunities here in Asia as well, which is, in a way, some say, playing catch-up. The likes of Japan, some have said maybe even Australia. Where do you see these opportunities?
So we see effectively growth in Europe. We see more and more growth coming from Asia. Asia, by the way, at large, is a fast-growing area for asset management, both in public markets and in private markets. You mentioned Japan. Yes, it's true for Japan, but also the rest of Asia, that part of the world, around Hong Kong, China, but also Southeast Asia.
And here in Hong Kong, we have to talk about China. How are you assessing the Chinese market? I mean, already when you take a look at the economy, some say there are signs of a turnaround. And when you take a look in terms of sentiment, some say the animal spirit is back.
So we see indeed more interest into China. We've seen European clients wanting to invest into Chinese assets classes. By the way, M&G just launched 2 products, one Chinese equity fund and one Chinese credit fund. We announced that actually in March this month because to effectively reply to clients' demand. So we do see increased appetite in China after a quite difficult time over the past 2-3 years.
What's still challenging when it comes to investing in China, you think?
I think the key topic is transparency, governance, to make sure that investors understand where they invest into. For sure, using asset managers to help them invest into would be quite helpful. But probably the transparency, the governance is the key topic. And we've seen some improvement in that area over the past years.
But how about in terms of fundamentals in the economy? Some say that if you take a look at the property sector, it's still not where it needs to be. Consumption is also an issue. How are you assessing?
So what we assess, effectively, the construction sector, the real estate sector has suffered, as you said. That's clear. Having said that, when you talk about the economy broadly, and especially the consumption, looking at the potential of the population who can consume more, if you had to refer it to the US one, for example, there's still a way to go, a long way to go, but we do see an improvement down there as well. And indeed, if more consumption comes, that's where the growth will come from. And having discussed with some potential Chinese partners, we see effectively the need to help them diversify their asset classes and invest more and more in different categories of assets. And that's why we are optimistic in China.
Might you be looking for more partners in China as you look longer term?
So as far as we are concerned, we want to eventually distribute our strategies in China. We are having some conversations. It's still early days for us, but we do see a potential in this part of the world.
What, in 12 to 24 months, might something happen? Might we see you sign a deal with a partner in China?
I suggest you invite me in 12 months' time, and I'll be happy to tell you more about it. Absolutely.
We will certainly do that. I want to talk about Asia in the context of the global environment. Given the uncertainty and the weakness in the market that we're seeing recently for instance, in the US as well as Europe, I'm just wondering where Asia stands in relation to all of that.
I'd like first to come back to what you said on US. Yes, we've seen a lot of volatility in the market, a lot of uncertainty on the back of US administration's decision on trade, tariffs. First of all, investor has to look at it from a long-term standpoint and avoid the short-term noise. So you still need to look at your allocation from a long-term perspective and see where the potential is. So US remains an attractive place. Having said that, it is true that the recent volatility have created more opportunities, geographical opportunities, especially in equities, where we've seen investors rebalancing or reallocating money into European equities, but also Asian equities. That's what we've seen from our clients over the past 2-3 months. So a more
diversified portfolio.
Exactly. And Asian equities is taking a bigger and bigger part into it. We ourselves have created more opportunities for clients, more strategies, where effectively both in equities and fixed income provided to investors. And we've seen effectively the stronger demand coming from clients, especially European clients, wanting access to more Asian asset classes.
How does that allocation look like in terms of geography?
So usually it depends on where the clients sit. There's always a domestic bias from any investor. If you speak to a US investor, bulk of their assets are in the US, and then they will invest what they call internationally, i.e. outside the US. Depending on their size, they will invest into one category, which is global ex-US. If you move to Europe, you may have different kinds of investors. As you know, Europe is a sum of so many countries. If go back to, for example, the UK, where M&G is based, private clients invest a lot, for example, in Japanese equities. We've seen a lot of search for Japanese equities over the past 3-4 years, and now an increased demand for Asian equities as well. It's been quite substantial as they wanted to diversify away from just the domestic equities they've been overly exposed to. So that's an example of diversification we've seen, on top of access to European equities as well.
We've been talking about US exceptionalism. That seems to be easing a little. And some people are even talking about Europe exceptionalism now. Is it too soon to be talking about that?
I think there is a potential for Europe to grow, definitely. When I look at price earnings of stock markets in Europe versus US, it's probably half of what the US has been, at least at the end of last year. we've seen a surge of equity, valuations over the past since the beginning of the year. Equity markets have done well in Europe compared to US. But again, if you take a long-term perspective, I do believe US will remain as the first center of investment for clients.
But it's still looking expensive, despite the recent sell-off in the US. I mean, valuations at 20 times earnings, that is still among, if not most expensive in the world.
It's still very high. I agree with you. So what one could say is that probably the growth of the equity market we've seen over the past 2 years in the US may not be replicated over the next 2 years, as it's been quite high. And the recent, let's say, valuations since January have proven it. Having said that, it remains, a place where you need to be invested. Compared to Europe, where probably effectively the price earnings have been around 14 to 16, roughly, depending on the countries in terms of price earnings, and you see effectively a growth potential out there. So I do believe one has to remain extremely diversified. That's why don't invest only in the US, keep investing more and more in Europe, but also in Asia.
Have you been surprised? We've been seeing a lot of volatility in the market, but when you take a look at the VIX, it's pretty low. I think today 16, 17. I mean, is the VIX broken, or is there actually not as much vol as we think there is?
As I said, there is a lot of noise out there, and one has to look at a long-term perspective. And this is where, at the end, looking at the VIX, it reflects exactly what you said, which is lower than what, let's say, the press sentiment may be compared to what the market is saying. So that's why our advice to clients is to remain diversified, have a long-term view of the markets. There could be some geographical opportunities, exactly as you've just said, Europe and Asia, while looking at the long term. When you move to fixed income, we see strong demand for income, by the way, from clients. There are opportunities investing into credit and get some nice income from it. Again, being diversified across geographies.
I know, and I hear it very clearly, be diversified.
Absolutely.
But if you had to choose one asset to hold for 2025, what would that be?
I think there will still be a growth in private markets. When you've just seen what Germany has announced as a plan to invest into the economy, we've seen a lot of demand for infrastructure, a lot of demand from private credit, but also even when the UK has suffered, for example, last year and the year before in real estate, we see now investors wanting more and more real estate again. So private market remains, very hot for our clients. That's probably effectively where we see the most growth at M&G.
Joseph, it's been a pleasure having you with us. Thank you so much for your time today.
Thank you.
Joseph Pinto, CEO at M&G Asset Management. Now, still to come, as Sri Lanka leaves its interest rate unchanged at 8%, we get the policy outlook exclusively from Central Bank. You're watching Insight, and we're keeping an eye on the Sri Lankan rupee, in particular on the back of the Central Bank keeping rates unchanged. The currency currently stronger versus the USD by about 0.1%. Remember, this is a country that is in deflation. Inflation, though, expected to return by June this year to reach a target of 5% by the end of 2025. Now let's get insights into Sri Lanka's monetary policy direction with the central bank governor himself. P. Nandalal Weerasinghe will be joining us live from Colombo. Governor, good to have you with us. Give us a sense of why you kept rates unchanged.
When you look at the last monetary policy review and also the inflation, the position that we took last time versus this review, the second monetary policy review for this year, but we see forward-looking basis, inflation, although right now is a deflation, in our predictions is clearly indicate we will come back to the positive inflation from the second half, and towards the end of the year we will be reaching towards our target of 5%. This is one reason. And also, although this current deflation is temporary transition as a result of some administrative price changes, it will dissipate over a period of time, then it will come back to our normal, based on demand inflation, it will come back to our normal range. And also the fact that economy has been performing much better than expected. For example, 2024 economy grew by 5% compared to the other expectations. And also we see continuous recovery in the economy, and also the credit is flowing nicely. Monetary policy easing cycle we are in, that has basically transmitted into market interest rates quite nicely. So we see it's a kind of a monetary policy transmitting into economy nicely, and also inflation is going to come back to a positive territory from the second half onwards. As a result, we thought this is a right, appropriate monetary policy stance for the time being.
So there's a lot of confidence that there is a reversal in the economy coming. What might be some of the risks?
So obviously, on the domestic side, I think we had a lot of risks and uncertainties in the past, especially before the completion of the debt restructuring that has already completed. And also the IMF program, the third review has already been completed. We are in the process of basically, completing the next fourth review. So a lot of uncertainty we had from the domestic side now is pretty clear. Government has already announced the government new administration also will be moving into the same kind of path where IMF program will continue. Debt restructuring already completed. Government yield rates are also stabilizing nicely in line with multiple stance. I think domestically we are in a much better and less uncertain place. But if you look at externally, this is where we mentioned in our press release also, there's some uncertainties globally, mainly coming from the U.S. administration, the tariff policies, how that's going to have impact on the Sri Lankan external demand. We have to wait and see. Those are some of the uncertainties, and also geopolitical issues, and also kind of the commodity prices are a little uncertain. That's where we are monitoring, but I don't think in the near term we are going to have a significant impact on that, but we have to monitor closely and see whether this is going to have impact on our economy.
In your own calculations, though, how much of an impact do you think those tariffs might have on the Sri Lankan economy? Might it shave off 0.5% of your growth or more?
No, it's too early to come up with the estimate, because there's a lot of things are uncertain. As I said, when you look at Sri Lankan trade deficit or kind of a market access to US, Sri Lanka is not one of the biggest countries which have market access. I think we are somewhere around 35th place in terms of our market access to US markets. There are bigger markets that US probably administration is focusing on right now. We are only about 2 billion trade surplus with the US right now, mainly focusing on the garment industry, where apparels and garments are major market access to the US. Of course, this we have to wait and see. I don't think this sector is not going to have a significant impact, because it's highly unlikely, although there may be high tariffs, but this kind of products, it's highly unlikely that production basis would be moved into the US, whatever the tariff rates. It will only increase the cost of the imports for the US, but still we think there could be trade diversions. But for that, we have to do the proper assessment once they see clearly the impact of tariff on other bigger markets, and especially on the apparel sector.
Governor, your IMF program will be under review soon. What factors, what indicators will be under scrutiny, you think? Do you expect the IMF to be satisfied with the progress made so far?
I think if you look at the statements issued by the IMF, they are very satisfied, and they are basically of the program performance so far. Recently, IMF issued the op-ed as well as the statement, and board assessment was very positive so far. So the IMF expectation is to continue in the same path. Clearly, mainly the fiscal consolidation, revenue-based fiscal consolidation, and addressing governance and corruption issues in terms of governance reforms. Those are two key areas. Obviously, on the monetary policy side, this is not a concern, because we are pretty much in the deflationary, and we are recovering the inflation, and also economy is growing fast, recovering well after the crisis. So from the IMF point of view, I think what's important is to stay in the same path, maintain kind of reforms that government has agreed in terms of cost recovery pricing, implementing all the governance reforms, revenue-based fiscal consolidation, meeting the revenue targets as we agreed with the government, with the IMF commitment to meet all the targets, and implement all the necessary reforms and submit the budget. That was already completed. So next phase of the process is to ensure that we move in the same direction as a country we have committed, And I'm sure there's a lot of confidence. And the assurance from the administration that they will move in the same direction, I think that's a positive response.
Governor, what else is needed for your debt restructuring?
I think we have already completed almost, for example, Euro bonds already completed. Is new instruments already trading in the market quite nicely. In terms of bilateral MOUs have already been signed. Basically, we are in the process of signing bilateral agreements each and every country of the Official Credit Committee, including India, China, all the members of the Paris Club. So we saw already Japan has signed and completed all the agreements, and they are basically going to resume their new projects that they have committed earlier. And likewise, India also now, we are in the process of finalizing, documenting, and finalize the agreements with each and every country.
Right.
That is a normal process. That will take place soon.
Governor, thank you so much for your time. P. Nandalal Weerasinghe, Governor of the Central Bank of Sri Lanka. And that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.